So good to have you join us today on this edition of Business Daily. Coming to you live from Seoul, I'm Lee Ji-yoon. Before we get started, let's first take a glimpse of today's highlights. Korea is losing tens of thousands of jobs every year due to declining foreign direct investment in the country, which has been falling since the early 2000s. Once considered economic giants that helped the country rise from the ashes, Korea's conglomerate chaebol have been identified by some as a threat to the overall economy. Is it time for Korea to do away with its trickle-down economics? But first, Korea's central bank decided to continue its wait-and-see approach by holding its key interest rate steady at 1.5%. Such a decision was widely expected as the economy is facing a number of obstacles from in and outside of Korea. Our Hong Jie has this report.
In its monthly monetary policy meeting on Thursday, the Bank of Korea decided to stand pat on its record low key interest rate of 1.5% for a sixth straight month. The top central banker said it's keeping a close eye on the U.S. Federal Reserve's meeting next week, where policymakers are expected to raise the interest rate for the first time in almost a decade.
A rate rise in the U.S. does not necessarily mean the BOK will directly follow the suit. We will be monitoring capital movement in emerging economies after the liftoff and how the domestic economy reacts to these changes.
The governor also differentiated Korea from other emerging markets, saying a massive capital outflow following a rate hike in the U.S. is unlikely due to the country's strong fundamentals like its bountiful current account surplus and foreign reserves. Still, the economy faces uncertainties from feeble global demand, especially from China, that played a big part in negative growth every month this year in Korea's outbound shipments. Conditions at home do not look so bright either. The country's household debt is rising fast, already exceeding $1 trillion, and many point to government spending as being the main driver behind better than expected performance in the third quarter. Given that, a lot of analysts are expecting no change in the key rate for quite some time.
But I think next year is going to be the same kind of growth path as this year. So if it's so, I think BOK will hold it throughout the next year.
Now, much focus is on the BOK's new growth outlook for 2016 that will be released next month. The Bank of Korea currently expects the Korean economy to grow 3.2% next year, but some say low global oil prices could lead to a downgrade of that forecast and that this could signal further rate cuts down the road. Hong Jie, Business Daily.
A fall in foreign direct investment here in Korea is leading to the loss of thousands of jobs every year. Now, why the drop in investment and what cost does it come at? Our Shin Se-min explains.
Korea is losing 130,000 jobs every year as the result of falling foreign direct investment in the country. In its latest report, the Korea Economic Research Institute says the cumulative number of jobs lost from dwindling foreign investment stood at 927,000 since 2001. Leading up to 2013, that would be an annual average of 71,000 jobs Korea could have had, but didn't manage to secure. Fewer jobs mean lower production, with figures showing that tumbling FDI has cost Korea over $122 billion since 2001. Simply put, the average loss in production per year between 2001 and 2013 neared $10 billion. Inbound foreign capital has been contracting since the early 2000s on the back of a strict labor market that offers less flexibility for companies. The net loss for direct investment also signals that more Korean firms are now doing business outside of the country in search of more lucrative markets for operation.
For local firms that are looking to get a better deal in price competitiveness by setting up production lines overseas, the government should come up with more measures to keep them home.
Complicated business regulations are another factor that experts say hinder many foreign investors from putting their money in Korea, adding that the government's reform drive should be able to ensure there is a better balance between foreign investment flowing into Korea and the amount heading out. Shin Se-min, Business Daily.
Korean industries are finding themselves in increasingly hot water. A major business lobby group says that Korea's reputation as a technologically advanced and price-competitive country is being challenged by its neighbors. Our Lee Joo-young tells us more.
This is China's popular smartphone brand Xiaomi. 60 million units were sold last year, and the company was recognized as the world's most valuable tech startup. Over in the shipbuilding sector, Chinese companies won 80% of the world's orders in October this year, leaving Korea at a record 5-year low. These are some examples of China's technological advancements over the years, also highlighted in a survey by the Federation of Korean Industries on 30 business associations and organizations. The survey compares the competitiveness of Korea, Japan, and China. Out of the 24 organizations that commented on the nation's technology gap with China, 80% said the neighboring country has already outrun Korea or is projected to within the next 3 years. Korea's competitive edge on price over Japanese products may no longer be the norm either, with 70% of the respondents agreeing that Korea is either behind or at similar levels. In terms of the overall state of Korea's current economy, almost 67% believe it is in critical condition and that this trend will last for some time. In the face of its eroding strengths, the Federation said Korea needs to implement more drastic measures on the government level, like relaxing regulations on corporations and granting more tax benefits, as well as providing ample support in R&D activities for the country to regain its leverage in the global market. Lee Joo-young, Business Daily.
With the end of the year fast approaching, automakers are releasing brand new models one after the other. As the market heats up, no category is off limits as we see new models of large sedans, sports cars, and SUVs. Our Eunice Kim has more on what's on offer.
Some say the most anticipated new model comes from Hyundai's recently minted luxury line. The first from the Genesis brand is the EQ900, or the G90 as it's known in overseas markets. It launched in the Korean market to great fanfare on Wednesday, with plans to go global in the new year. Hyundai Motors says its new flagship luxury vehicle, to rival the best in German car making, has already attracted more than 10,000 pre-orders. On the other end of the aisle, sibling rival Kia Motors rolled out an updated version of its compact K3, known as the Forte or Cerato elsewhere, and a brand new K5 hybrid.
The fuel efficiency of the K5 hybrid 17.5 kilometers per liter. It's a marked upgrade in terms of fuel economy.
And then there are the imports, which exceeded 200,000 in domestic car sales this year. They show no sign of slowing down. For Italian nostalgia, there's the Fiat 500C for convertible, and the new Mini Clubman retains its iconic design. Capturing the dreams of many speed devils are the Ferrari 488 Spider and the Nissan 370Z. The all-new Lincoln MKX, Land Rover's Range Rover Sport SVR, to Toyota's fresh RAV4. SUVs in 2016 once again come in all types of snazzy sizes and styles.
The all-new Lincoln MKX is perfect for the premium full-size SUV customer with its built-in state-of-the-art technology and personalization options.
Then there's the new Honda Accord, the new Lexus IS 200T, the new Peugeot 500, all lining up to win the hearts of drivers searching for their on-the-road companion in 2016. Eunice Kim, Business Daily.
Now, just yesterday, we told you about how businesses here in Korea and around the world are struggling amid the slowing global economy. And today, we're going to take a look at the trickle-down effect seen in the Korean economy and why the OECD says that Seoul should no longer depend on it. Take a look.
In its latest report handed over to the Korean government, the OECD said the economic benefits trickling down from the country's conglomerates are limited. It urged Asia's fourth largest economy to ease regulations on small and mid-sized companies and further develop the service sector for a paradigm shift in growth. Many experts have said the country's rapid economic success produced over the course of half a century came mostly from conglomerates or family-led chaebols. In fact, Samsung's 70-plus companies generate revenues equivalent to 25% of Korea's GDP. Up until now, Seoul has put forth conglomerate-friendly economic policies, saying that benefits from big firms and the rich will trickle down to small companies and low-income earners. But there are now growing calls for a change in policy, with the IMF and global economists warning this practice only aggravates social inequality and fails to produce tangible results.
And to tell us more about this, Professor Kim Se-wan of Ewha Women's University joins us in the studio today. So good to see you, Professor.
Good afternoon.
All right, so let's start by talking a little bit about how the Korean economy was able to achieve such massive growth with the help of its conglomerates.
Well, from the beginning of the economic development, the big companies or chaebol companies were central to government's efforts to promote the nation from poor country to the rich country. Therefore, Korean government focused all the economic resources on chaebol or big companies. However, the benefits, economic benefits of the big companies were shared by related middle and small-sized companies. So we can reinterpret that ecosystem between large and small companies in terms of the trickle-down effect.
All right, then last June, though, we heard that a study released by the International Monetary Fund actually said that this trickle-down effect doesn't really produce results that it claims to. Can you tell us more about this report?
Yes, according to that report, there is less link between big companies' business and small companies' business all over the world, and Korea is not an exception. In the past, as I said before, the only way to increase the small-sized companies' benefits or middle class income is solid economic growth by supporting big companies, which is related to a trickle-down effect. But that kind of link has been weakened because of the two reasons recently. The first is big companies outsource their needs from foreign small companies. So there is less demand from the domestic small companies. And second is Korean big companies are pretty much focusing on high-tech industry, like IT industry. So that means big companies are growing without increase of the employment. So we have a weaker link between big companies and small companies today.
And I'm sure this is something that Korea needs to take note of, considering that its dependence on conglomerates is quite high compared to other countries around the world, right?
Right. We have very interesting report from OECD about that issue. According to that report, Korea is simply the most heavily dependent on big companies out of the OECD member countries. So, for example, the Samsung's sales revenue covers about 14% of the Korean GDP. And in addition, Hyundai Motors sales revenue covers another 6% of the total GDP.
Wow.
So if we combine the two companies' sales revenue, that covers almost 20% of the total GDP of the nation. But of course, this is not an appropriate number to measure the impact of the big companies on the economy. But with that standard, Korea is the most heavily dependent on these two companies.
Well, can you tell us a little bit more about the other countries and how some of their conglomerates and their revenues per GDP compare?
Right. The second most heavily dependent on big companies is the UK. So the largest company in the UK is the British Petroleum. So that covers like 11% of the total GDP. But remaining 30-some countries, OECD members, 30 countries, dependence on largest companies of the country is less than 10%.
Okay, then this would also mean that if these conglomerates struggle, then this impact would be felt throughout the Korean economy as a whole, right?
Right. So we have to see that business is a very risky animal. So there's no forever winner in the business. And that's what we learned from the history. For example, the best 30 companies in the United States, only one survived in the last 100 years. That means the best used to be companies 100 years ago. 29 companies disappeared in the economy. So we should not expose our nation's economic destiny to the risk of the single company.
You gave us an example just now, but for example, Volkswagen also, Germany's automaker Volkswagen, its emissions rigging scandal actually dealt a huge blow to the entire German economy. Can you give us more examples like those from other countries?
We have very famous example with the Nokia from Finland.
Nokia.
And when their business is at the peak around 2009, Nokia's sales revenue covered almost 30% of the Finland's GDP. But they almost collapsed at around the 2010 and 2011. And that came with a big wave to Finland's economy. So that decreased the Finland's GDP by 2% in 2011. But let me reiterate the risk of the business related to Nokia. Nokia used to be one of the best company in cell phone industry.
Right.
But that went to almost bankruptcy after 3 years from the release of the new smartphone from Apple.
All right. Well, in order to, I guess, reduce the country's such high dependence on conglomerates, what do you think the Korean government should do from here on out, with its policies especially?
Well, even though our dependency on big companies is increasing, we can't drag their business down to the medium-sized level. Instead, we have to support the medium and small-sized companies and new business startups through more tax incentives and more business-friendly environments.
Oh, but then what's the Korean government stance right now, though, toward its conglomerates right now?
Well, the Korean government is taking both of the positive side and negative sides on big companies. So they acknowledge that as of now, the role of the big company is very important for maintaining the economic growth. But meanwhile, we have to support the medium and small-sized companies to develop our future potential and prosperity.
Okay, thank you so much for coming in today, Professor. And that does it for today. Thanks so much for watching, and we'll be back tomorrow at the same time, same place for your Business Daily. Until then, goodbye.